Finding genuine, high-growth stocks at sensible valuations is the single most difficult task in the current investing climate. Force Motors is currently valued at roughly 24,000 crore, but its internal metrics suggest a profile that deviates sharply from typical market expectations. The first layer of that profile reveals a strict zero-debt policy and a Piotrowski score of 8, indicating a high level of operational health. These fundamentals sit alongside a 3-year EPS growth of 221%, yet the company is trading at a PEG ratio of 0.10. This puts investors in a difficult position. Usually, a return on equity of nearly 30% requires paying a massive premium, or it means you are looking at a highly leveraged value trap. When the numbers are this extreme, we have to ask a specific question. Is this vertically integrated manufacturer a long-term compounder? Or are we simply seeing a cyclical peak before a major decline? Evaluating that requires looking past the ticker symbol to the physical infrastructure. Force Motors has operated as a manufacturing fixture since 1958. They operate as a fully vertically integrated manufacturer, designing and building automotive components and vehicles on a single integrated assembly line. Their output reaches global markets, supplying light commercial vehicles to the Middle East, Asia, Latin America, and Africa. In India, their presence is established through passenger mobility solutions, like the Traveller van, which is a staple of the commercial transit sector. They are currently expanding this core lineup with the Urbania series, aimed at the higher capacity monobus market. Before analyzing the returns, we have to recognize the capital-intensive nature of heavy manufacturing. That reality dictates the trade-offs an investor must accept. To understand the return on investment, we start with the entry price, a standard PE ratio of 23.0. This chart compares entry cost to immediate performance. Profit growth hit 91.9% last year. Extending to 3 years, profit variance and EPS growth reached 221%. Looking back 5 years, a 35.4% sales increase and 65.5% profit variance confirm a sustained trend of compounding. These numbers are supported by a return on capital employed of 36.1% and an operating profit margin of 16.4%. This performance leads to a stark valuation gap. Despite these metrics, the market has assigned the company a PEG ratio of 0.10. A ratio that low suggests that investors collectively expect a significant slowdown in future earnings. The trade-off for the investor is deciding if the current sales velocity can withstand the cyclical cooling the market is pricing in. Stability in the automotive industry depends heavily on the strength of the balance sheet. It is rare for a manufacturer of this scale to carry no debt, but Force Motors maintains a debt-to-equity ratio of 0. Their cash management is exceptionally tight. As this flowchart shows, they average only 7.70 debtor days for collections. Combining that cash efficiency with 0 debt results in an interest coverage ratio of 401. There is a trade-off to this conservative approach. The company must fund all factory expansion and R&D through internal cash flows rather than taking on debt to grow faster. Allocation of that capital is centralized, with the promoters holding a 61.6% stake in the company. This debt-free status functions as a financial fortress, allowing the company to navigate interest rate shifts and industry slumps that would threaten leveraged competitors. Part of their internal cash is consistently reinvested into the future, with 5% to 6% of revenue dedicated to R&D every year. In the commercial sector, this investment has secured a roughly 70% market share in light commercial school buses and ambulances. They are also leveraging this research in the consumer segment with the launch of the Gurkha off-road platform. However, there is a segment of the business that is less visible to the public, but vital to the company's valuation. This breakdown shows their revenue sources: 48% commercial vehicles and 36% motor vehicle engines. This engine revenue comes from partnerships with global names like Daimler, BMW, and Rolls-Royce. The scale is significant, supplying over 150,000 engines for Mercedes-Benz and 70,000 for BMW. This revenue stream means that the company is tied to the sales cycles of global luxury brands, not just domestic commercial transport. This dual revenue stream, combining high-tier luxury component manufacturing with commercial vans, is what supports their consistent R&D spending. In summary, Force Motors is an efficient, zero-debt powerhouse with a significant B2B engine business supporting its commercial lineup. Professional investors have noted this profile. with foreign institutional investors currently holding a 10.9% stake. To decide if this belongs in your portfolio, consider this scenario match matrix. This stock fits a growth at a reasonable price, or GARP, strategy. It is for investors who prioritize high ROCE and strong profit growth, but refuse to pay a high valuation for those traits. It is likely not for those who prefer asset-light businesses or lack the patience for the capital-intensive cycles of heavy manufacturing. Does the scale of their engine partnerships with Mercedes and BMW change how you view their growth potential? Tell us in the comments. With a PEG ratio of 0.10, Force Motors represents a rare, data-backed opportunity for asymmetric growth in the industrial sector.